Hey everyone, welcome back to Wealth Takeoff, where we make investing easy and practical. Have you ever looked at a stock and wondered, is this company actually doing well? So, today I'm breaking down the most important financial ratios you need to know with simple examples and explanations that anyone can understand. So, what are financial ratios? Financial ratios are like the health stats of the company. They tell you how profitable, efficient, and financially strong a business is. There are different kinds of financial ratios. We have profitability ratios, leverage ratios, efficiency ratios, liquidity ratios, and valuation ratios. We'll cover the most important ratios from these categories. Let's start with return ratios. These ratios show you how efficiently a company is making profits from the money that it has. There are three different ratios: return on equity, return on assets, and return on capital employed. We are going to go over these. Starting off with return on equity. So, return on equity tells you how well the company is using shareholders' money to generate profits. The formula is net income divided by shareholders' equity, and you can find the net income and the net income you can take it from the income statement, and the shareholders' equity you can take it from the balance sheet. And as a benchmark, 15% of ROE is considered excellent. So let's say Netflix makes 5 billion in net income and shareholders have invested 20 billion. So this would give you an ROE of 25%. This means that Netflix is making 25 cents of profit for every dollar that is invested by shareholders, and this is not bad at all. High ROE can often signal great management and a strong business model. Next, let's look at return on assets or ROA. What this signifies is how much profit the company earns from all its assets, like buildings, tech, or equipment. So the formula is net income divided by total assets. You can find net income in the income statement, and the total assets you can take it from the balance sheet. As a benchmark, 5 to 10% of ROA is considered good. So imagine a delivery company like FedEx. If FedEx has 4 billion in profit and 50 billion in assets, the ROA is 8%. That means for every dollar invested in trucks, facilities, and planes, they earn 8 cents back. So that's a good ROA. Next, let's look at return on capital employed, ROCE. What ROCE means is how efficiently the company is using both equity and debt to generate profits. So the formula for ROCE is EBIT divided by total assets minus current liabilities, or the capital employed. So you can find the EBIT from the income statement, total assets and liabilities you can take it from the balance sheet. And as a benchmark, 12 to 15% for ROCE is considered solid. For example, let's say you have ExxonMobil and it uses $100 billion in capital to generate $14 billion in operating profit, or EBIT. So the ROCE will be 14%, which is a strong number, especially in capital heavy industries like oil. Next, let's move on to margin ratios. This is also part of the profitability ratios. So margin ratios tell you whether the business is actually profitable. Just because a company makes sales, it doesn't mean it's making money. Margin ratios show how much the company keeps after covering the costs. So let's look at the first ratio in margin ratios, the gross margin. So what is gross margin? Gross margin is what's left after you subtract the cost of goods sold from revenue numbers. So the formula is revenue minus COGS, or the cost of goods sold, divided by the revenue numbers. And you can find the revenue and COGS numbers from the income statement. So good benchmark for gross margin is 30 to 70%. So high gross margins indicate strong pricing power and efficient production. For example, if Apple sells an iPhone for $1,000, if the parts and assembly cost $400, the gross margin will be $1,000 minus $400 divided by $1,000. This is 60%, which is a good gross profit margin. Next, let's look at the operating margin. Operating margin tells you how profitable the company's core operations are before deducting interest and taxes. So the formula is operating income divided by revenue. You can find the operating income from the income statement, and the revenue also you can take it from the income statement. So good benchmark for operating margin is 10% plus. For example, if Microsoft's operating margin is around 40%. This means that for every $100 they earn, they keep $40 after operating expenses. Next, let's look at the net profit margin. So the net profit margin is what's left after all expenses. This includes taxes and interest. The formula is net income divided by revenue. You can find both net income and revenue from the income statement, and a good benchmark is 10% plus again. So it's not just about sales, it's about what the company gets to keep. So Walmart, it sells a lot, but margins are razor thin. If it earns $10 billion on a $60 billion in revenue, that's just a margin of 1.6%. So compare that with Meta, which might have 20 to 30% net margins. So that's another ratio we need to look at. Next, let's look at the leverage ratios. So leverage ratios tell you how risky the company's debt situation is. So we're going to look at debt to equity ratio and debt ratio. So debt to equity ratio tells you how much debt a company has compared to shareholders' equity. So the formula is total debt divided by shareholders' equity. So total debt includes short-term debt, long-term debt, and other fixed payments. You can find debt in the balance sheet, and shareholders' equity also you can take it from the balance sheet. So less than 1 means it is conservative, the company is conservative. More than 2 means the company is high risk. So for example, Tesla has a debt to equity ratio below 0.5, so it's a low risk company. Meanwhile, some airlines go over 2 during tough times, which means it indicates high risk. So high debt to equity ratios may mean that the company is over leveraged and is vulnerable during downturns. Next, let's look at the equity ratio. So equity ratio indicates what portion of the company is funded by owners versus creditors. So the formula to calculate equity ratio is shareholders' equity divided by total assets. And you can find both these from the balance sheet. As a benchmark, 0.5 plus is considered safe. The higher the equity ratio is, the less reliant the company is on debt. Next, let's look at the debt ratio. Debt ratio indicates what portion of total assets is financed through debt. So the formula is total debt divided by total assets. Total debt includes short-term and long-term debt, and you can find both total debt and total assets from the balance sheet. As a benchmark, 0.3 to 0.6 is healthy for debt ratio, and too much debt can become a burden if earnings slow down in case of downturns. So that is one ratio you need to take into account. Next, let's look at the liquidity ratios. So liquidity ratios show whether the company can cover its short-term obligations. That is, if they can pay their bills. We're going to look at current ratio, quick ratio, and debt ratio. So current ratio measures whether a company can pay off its short-term liabilities using its short-term assets. So the formula is current assets divided by current liabilities, and you can find both in the balance sheet And as a benchmark, 1.5 to 2 is a healthy current ratio. If the current ratio falls below 1, the company may not have enough. Next, let's look at the quick ratio. So the quick ratio is a more conservative version of the current ratio. It excludes inventory and focuses only on the most liquid assets, things that you can turn into cash quickly. So the formula is cash plus marketable securities plus accounts receivable divided by current liabilities. You can find cash, securities and receivables in the balance sheet, and also the current liabilities you can take it from the balance sheet. So for the quick ratio, a benchmark of 1 or higher is a solid quick ratio. So basically this quick ratio tells us that the company can pay off its bills without selling any inventory, and this is especially useful in industries where inventory is slow moving like furniture or machinery. Next, let's look at the cash ratio. So cash ratio is the most conservative liquidity ratio. It only counts cash and cash equivalents and assumes that the company has to pay all its short-term liabilities just using cash and cash equivalents. So the formula is cash and cash equivalents divided by current liabilities. You can take cash and cash equivalents from the balance sheet. Current liabilities also is available from the balance sheet. As a benchmark, 0.5 to 1 is considered a prudent cash ratio. So a low cash ratio is not always bad. Some companies prefer to invest their cash, but if it goes too low, it could signal liquidity issues during tough times. Next, let's look at price ratios. So price ratios tell you how expensive a stock is relative to what it earns. So these are the price ratios we are going to cover. So first let's look at earnings per share. Earnings per share shows how much profit is earned for each outstanding share of stock. So the formula is net income minus preferred dividends divided by weighted average of shares outstanding. So net income, you can take it from the income statement, and shares outstanding, you can take it from the 10K filings or from sites like Yahoo Finance. So as a benchmark, the higher the EPS, the better, and look for consistent EPS growth. So EPS is a key metric that drives the stock price over time. Next, let's look at the price to earnings ratio. This tells you how much investors are paying for each $1 of earnings. And the formula is share price divided by earnings per share. So share price, you can find it from the market data on Yahoo Finance and other such sites. And EPS, you can find it in the income statement. As a benchmark, 15 to 25 is a good average for EPS, and more than 30, if EPS is above 30, there are high growth expectations from the stock. So high PE doesn't always mean the stock is overpriced. It could reflect high growth expectations. Next, let's look at the PEG ratio. So this ratio adjusts the PE ratio by factoring in expected earnings growth. So the formula is share price divided by EPS divided by the EPS growth rate. So you can find this in analyst estimates on sites like Yahoo Finance or Seeking Alpha. As a benchmark, if the PEG is below 1, the company is undervalued, the stock is undervalued. If it's at 1, the company is fairly valued, or if it is more than 1, the stock is overvalued. So a PEG under 1 is a good sign that the stock might be undervalued relative to its growth. Next, let's look at the price to book ratio. So the price to book ratio compares the stock price to the book value of the company. It's essentially what you'd get if the company is liquidated. So the formula to calculate this is market cap divided by the book value per share. So you can find the book value from the balance sheet, and the market cap you can find it in the market data on Yahoo Finance or Seeking Alpha or several other sites. A good benchmark is 1 to 3 for this ratio. If it's less than 1, it may indicate that the stock is undervalued. So this is often used for banks and asset heavy companies. Next, let's look at the price to sales ratio. This ratio shows how much investors are paying for each dollar of the company's revenue. So the formula to calculate price to sales is share price divided by total sales. Share price is again taken from market data from Yahoo Finance, and total sales you can take it from the income statement. So on average 1 to 3 is typical as a benchmark for this ratio. Less than 1 might mean that the company is undervalued. So this is great for early stage companies that haven't turned a profit yet. The next ratio is price to cash flow. This ratio shows how much you're paying for each dollar of a company's operating cash flow. So the formula for this ratio is share price divided by operating cash flow per share. Operating cash flow you can take it from the cash flow statement, and share price and outstanding shares you can take it from the market data. As a benchmark, 5 to 15 is healthy. Less than 10, maybe the company is undervalued, and more than 10, the company may be overvalued. Next, let's look at enterprise value ratios. So enterprise value includes debt. So these ratios show the total cost to buy the business. So you're going to look at 3 ratios: EV by EBITDA, EV by EBIT, and EV by revenue. So EV by EBITDA compares enterprise value to EBITDA, and it's useful for evaluating the takeover value. The formula is market cap plus debt minus cash, that is the enterprise value, divided by EBITDA, that is the earnings before interest, taxes, depreciation and amortization. The net debt you can take it from the balance sheet, and EBITDA you can take it from the income statement. Market cap you can take it from the market data on Yahoo Finance. So as a benchmark, 6 to 10 is reasonable. Less than 6 may be undervalued, and more than 12 it suggests that the stock is overvalued. EV by EBIT is the next ratio. EV by EBIT indicates how much an investor is paying for a company pre-interest, pre-tax operating profit. Like EV by EBITDA, but subtracts depreciation and amortization for a more conservative view. So the formula is enterprise value divided by EBIT. You can find the net debt in the balance sheet, and EBIT you can find in the income statement. As a benchmark, 7 to 12 is typical for this ratio, and it's useful when comparing mature companies with significant capital costs. The next ratio is EV by revenue. It compares enterprise value to revenue, including both debt and equity. So the formula is enterprise value divided by revenue. You can take the revenue from the income statement. Enterprise value, you can either take it from market data or you can calculate it. So as a benchmark, 1 to 3 is typical. Less than 1 may indicate that the stock is undervalued. More than 10 may indicate that the company is having, there are very high growth expectations from the company. It can also mean hype. And that's your complete guide to financial ratios, explained with formulas and where to find everything. Remember that no single ratio tells the whole story. Always use multiple ratios together. Compare ratios over time. A 10% ROE now may look great, but if it was 20% 2 years ago, then something's wrong. Also check industry benchmarks. A good margin for a retailer might be a terrible margin for a software company. So let me know in the comments, which ratio do you look at first when analyzing a stock? Personally, I use the P ratio. And now I've started using a combination of ratios. So if you found value in this video, don't forget to like and subscribe so you never miss an update. Thanks so much for watching, and I'll see you in the next one.